items there. Good morning, everybody. Welcome to this press conference at the Reserve Bank and to the release of the Reserve Bank's September monetary policy statement. The Reserve Bank this morning is leaving the official cash rate unchanged at 2.5%. In our statement, you will see that we have more evidence that the contraction in economic activity is now coming to an end and that we're seeing signs of a patchy recovery underway. This recovery is driven partly by a recovery that we're starting to see in our trading partner economies. This has been evident during the June quarter, and we think it's likely to continue in the short term. In addition, domestically, we're now seeing that retail spending has stopped contracting and that there is an increase in net migration and a recent pickup in housing as well. If we look into the medium term, we see a growth outlook that still remains weak. We're expecting household spending to grow only modestly into the medium term, and that's due to quite weak income growth and to a reduced appetite for risk amongst households. In addition, business profits remain under pressure from low activity and from the high New Zealand dollar, and that really means that employment and investment are not going to rebound fast. For medium-term sustainable growth in New Zealand, we do need improved competitiveness in exports, and we need to see continued recovery of household savings as well. We believe this rebalancing is required to stabilise New Zealand's external payments position. If the exchange rate were to continue to appreciate, or if we were to see the recovery in house prices undermine the savings recovery, then the sustainability of this medium-term recovery is much less certain. CPI inflation is comfortably within the band now and stays within the band in our medium-term forecasts. Our forecast recovery in economic activity is based on monetary policy continuing to provide substantial support, and we expect that such support is going to continue to be needed for some time. And that's why we continue to expect to keep the official cash rate at or below current levels through until the latter part of 2010. Thank you, ladies and gentlemen. That's the end of the formal part. We're here to answer any questions, and to assist I've got Dr. John McDermott, Head of Economics and Assistant Governor, and David Drage, Head of Financial Markets Research. Do we have any questions?
How worried about the threat to the longer-term sustainability of the recovery are you, given that you've kept this opportunity to cut further the official cash rate? Doesn't that kind of undermine your argument somewhat? You're potentially throwing more fuel on the fire of that housing recovery?
Well, we clearly have considered the option of cutting the interest rate further, but that would actually pour more fuel on any possible fire. Actually, we don't see a fire happening. We see some muted recovery in the housing market. We see that continuing at a level which is consistent with households continuing to reduce their savings. Sorry to be a bit double negative on that, but that's what's actually happening. We are talking about a recovery without the amount of rebalancing that we might have expected a little while ago. And actually, a number of countries are going through this sort of feature internationally as well. We do think that there are vulnerabilities in this medium-term growth picture, and they're particularly focused around the exchange rate.
Dr. Bollard, if you had to choose between removing the easing bias or cutting the OCR again, which would you have chosen?
What we've chosen to do, Simon, is to leave the official cash rate unchanged at 2.5% and repeat our statement that we expect to keep the official cash rate at or below its current level through until the latter part of 2010. In addition, to help you understand that, we have a 90-day interest track forecast in the monetary policy statement. You won't find better guidance than that from any central bank around the world. You do your bit.
Dr. Bollard, do you think the trading banks have finally got the message on interest rates?
Since our April cuts, which weren't passed on to the trading banks, we have seen margins reduce a little, and that's happening despite the fact that banks are still having to pay quite significant amounts for domestic deposits. We've seen a bit of action in terms of reducing floating rates. We've seen some steepening of some of the longer term rates. That's not out of line with what we might have expected to see.
Dr. Waller, just to follow on from Simon's question, just around the, you're talking about the latter part of 2000.
Sorry, just 1 second. Patrick, have you got a microphone there?
Sorry about that. Is that much better? Great. I know, I should know about microphones. Just around that, you're talking about the latter part of 2010 before interest rates may move again. I just wonder, the market and some economists don't believe that. They think you're going to be coming a lot forward before then. So what's the difference? Why is the market not believing you?
Well, I guess you need to ask the market that, as you will have observed, the market was very, very negative up till a point early this year, and it thought that rates should go down and down further than we thought, even though we were signalling where we thought they would go. And then suddenly they flipped their minds and decided that rates, if they weren't going to continue down, had to move up. Markets don't do stability terribly well. We're making it very clear what we think our views are.
Dr. Bollard, why do you think the New Zealand dollar is so high, and would a rate cut of any size made any difference to it?
We considered that very question, and our view very clearly, both in-house and from the markets, was it wouldn't make any difference. We think the New Zealand dollar is high for exactly the same reasons that many of the independent currencies around the world is high, i.e. that the US dollar is low and has been falling over this period. We have watched a number of our colleagues in South Africa, in Canada, in Israel, in Switzerland, all try various things around the FX markets in an attempt to get their own currencies down against the US dollar. They've had an initial very short-term effect, which has been gone in some cases overnight. We don't believe that there's much possibility of doing that while you've got a very large economic international driver, the US dollar adjustment, which is going on.
Sorry, Dr. Bollard, just once again, just on the markets. Look, I just wonder then, given that you're giving such a cautious approach, or almost a warning to markets about the medium term, I just wonder then why, in your set of this is what you're saying in your set of forecasts,